Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, we are on episode 52. Thank you so much for your support and encouragement, and hopefully, I will continue to educate you and we will learn together. This is Yield Nerd. We're going to look at a new topic, more so referred to in the world of alternate finance. And the topic is venture debt. What is it? How much risk are you taking? How much yield can you expect? And is it right for you in February 2023? That's what we're going to review. So let's take a look at how we're going to approach this. And before I do that, my usual disclaimers. I am not a wealth management advisor. I do not care whether you invest in venture debt or not. I'm here to educate, and this is not investment advice. Couple of things about who we are and how this is going to be organized. We will be reviewing the principle of venture debt. Why does it exist? Who raises venture debt? And we'll look at some of the common industry players that are there, new entrants and established players. And we'll look at what kind of yield can you get if you put your money in venture debt. And lastly, what are the most common indications for the prospects of venture debt in February 2023? Hey, if you're new to the show, I just want to let you know there is a playlist. The playlist takes you through sequential order, even if you're a novice to yield investing, starting from the basics of it all the way up to this episode. So consider looking at the playlist, and you may find other topics that are of interest to you as well. Having said that, let's go to venture debt. And what is the concept of a company taking on debt instead of equity? So in the initial beaker here, the concept is that the company is rich in equity and low in debt. And as the company takes on more and more equity, outside capital, the theory is that the company gets diluted. The owners own less, and outside money owns more of the company. So venture debt, when compared to venture capital, is simply a way for the company to get non-dilutive financing. And when they get non-dilutive financing, and if they are confident on their growth prospects, then the owners get to have more of their equity. And once they repay the debt, then they get to exit at a higher valuation with greater financing benefits or greater money to the owners of stock of the company instead of debt. So that is the general idea, the idea of leverage in order to get greater rewards for the company. How common is venture debt? One is a big fish, one is a little fish. You guessed it, venture capital was over 230 billion last year. Venture debt, 30 billion. So what does it mean in terms of one being a tenth of the size of the other? Well, it turns out venture debt has a lot of things going for it in the last few years. As the economy has recovered from the 2008 crash and it has generally had a giant bull market, if you're in a bull market, the company is going to be more confident that it is going to make it. Therefore, owners are more willing to take on debt, repay the debt, keep more of the equity, and exit with greater financial rewards. Surprise, surprise, if you look at the last 8 or so years, there have been more venture debt deals of a bigger ticket value, and therefore this is becoming a bigger and bigger presence. So the question then is, where is the market going to go in the next few years? And that will answer the question of where venture debt will go versus venture capital, or where both of them may go. So the way to think about venture debt and venture capital is not that they are somehow competing with each other. More often than not, venture debt is issued to companies that already have venture capital. Now, why would that happen? Have you ever thought about why a company would not just raise equity, but also equity and debt? Well, if it is their very first round, they may say, well, we just need a lower amount of equity and we're going to take off and we'll take the rest in debt. That is one reason. What if it is not the first round? There are many other reasons to raise venture debt. Assume for a moment that there is a market downturn. and the company raised venture capital, but they are running out of cash. Their sales cycle is slower, and they need to raise another round. Well, if you promised your investors that you're going to hit X million in sales, but you're not hitting it, you have two choices. You can go to the market and raise what is called a down round. The previous investors are going to be very upset at you because they thought they were going to get X out of the deal, and now you're going to raise new money at a more attractive term than the previous round, and that's not palatable. So the company needs some kind of a cash runway. And they don't have to go back and anger their previous investors. And they may just say, hey, you know what? We thought we were going to take off. We thought we were going to go to this big, wonderful future, and things are a little bit behind schedule. We don't want to raise a down round. We obviously don't want to go upside down. So we're going to raise debt. And that is one of the reasons why venture debt is raised. And if you sit back and think about the valuations of companies in the late 2020, after COVID, when the market emerged out of COVID, software companies went through the roof because people understood that a software company can operate remotely. There obviously were other industries, pharma, you name it, many industries adapted to operating remotely. And so companies were more confident. They raised debt. They came out of that hole when the market came back from COVID. And many of the creditors that lent via venture debt got their money paid back, and this became a very good business for them. And then hence you saw that bigger deals and more deals in venture debt. And so in a climate where companies are more likely than not to climb out of a hole, venture debt becomes a phenomenal thing to do. So who are the players that issue venture debt? A couple of things. I do not pick right and wrong. That is your choice. I do not have any affiliations. I do not have sponsors. And I really don't care whether you buy venture debt or not. I do this as an educational initiative. So here are some specific venture debt players. Take it or leave it. The old timers in venture debt, those that have been around for 10 plus years, some of them are Hercules Capital. They are in the New York Stock Exchange. They trade as HTGC. They are both a business development company and a venture debt company. If BDC is not a familiar term, flip back and look at a couple of the recent episodes. There is one that specifically talks about BDCs and who they are. There is also Triple Point. Triple Point does a couple of things as well. They've been around the block. They've been around for more than 10 years. WTI Western Technologies is a private company, and they invest in venture debt in a very large array of industries, and they do big, medium, small industries. I mean, it's a company that has very many different flavors in their ice cream, to put it differently. Well, all of these companies that have been around had this big aha moment. Their aha moment was that, hey, we can actually give debt to a company that does not make profit, that is burning cash, and it is a lower risk than what people thought. Think about it. If you are a lender, would you lend to a company that already is upside down and unable to meet its cash obligations? This is a head scratcher until you step back and say, who else cares about that company coming out of the hole? And we're going to talk about that in greater detail. But once this finding was realized that you could loan to an unprofitable company and come out ahead, the floodgates opened. Then venture debt issuers said, oh, I'll loan to big companies, small companies, profitable, not profitable. I do crypto, I don't do crypto. And the venture debt portfolio looks like a mishmash of everything of every size. So that also meant bigger players started showing up into venture debt. Blackstone, some of you may be familiar, they are a public company. They are in many different things. KKR certainly is a household name in the debt and financing world. Alliance Bernstein is a publicly traded company. Vista Equity Partners, they do some debt and some equity. Kind of goes back to the model we discussed a little bit earlier. And these people bring big debt tickets, hundreds of millions of dollars. And so the later players came in and said, okay, well, we got some of the other established ones doing tickets of a certain size. We will bring in big money to venture debt. So now let's put on the hat of an investor and say, what can you expect in terms of yield? And to understand yield, you need to understand how venture debt sits on the financing table, on the preference, as it is called, for money to be paid out. Venture debt is generally placed with seniority over every other creditor. Remember, the company has a cash crunch. They can either die or take on venture debt. So the venture debt issuer shows up and says, I'm the good guy, but I'm going to get my money out first. Push everybody else behind in the line, or I won't lend you. And the entrepreneur who says, I just need another year runway, I'm going to hit a home run, or the entrepreneur who says, I don't want to raise a down round, says it's either this or nothing, and they have to put the business as a collateral, sometimes their patents, their factories, their IP, everything under the sun. So in theory, not even in theory, in reality, the venture capital company is also pushed lower down the pyramid, so to speak. So the venture debt issuer gets first dibs on any kind of liquidation, on any kind of monies that are coming out of the company, and then the venture capital company. And venture capital, who has put in the money, have a lot of these skilled folks who say, I want to make sure the company succeeds, otherwise my limited partners won't invest in me. So the idea is that you have these specialized people who are going to make the company succeed. You are coming in a little bit later, but you're going to cut in the line and go to the front and sit back and wait for a short period. Venture debt is only issued for 2 to 3 years. And so as long as the company survives for 2 to 3 years and they have money to pay you back, you're good. You exit. That's the nature of the instrument, which means what does it mean to you as the investor? Let's look at the terms. Let's look at how it is issued. One of the first things that a venture debt company is going to say is our interest rate is a floating rate. You pay whatever is the prevailing interest rate plus a premium. For example, they may say add 7% to whatever is prime or whatever is a 10-year treasury. And in today's world, that's give or take 12% that is paid to the fund, which is a pretty good interest rate, especially in an increasing interest rate market. And then they're going to say, hey, you know what? We're the good people. We came in when your company could have failed. And we also want an extra sweetener. If you achieve all your goals and you go public and you have this incredible future, we also want warrants to buy some of your stock at a discounted price. And they may say 25% of what we lend you is what we're going to be able to buy. And imagine the company with a valuation of 100 million that is in a cash crunch, borrows 10 million and goes public at 300 million. Now the lender or the creditor has warrants that they can cash in at the valuation of 300 million and take another bite of the apple. So that may add another 7%, 8%. And to make sure the company is positioned for success, the creditor may say, and I want board observer rights. And they may say, we're going to be very nice. We're going to close the debt instrument in 6 weeks. If you go raise venture capital, you're going to be doing that for 6 months. Raise venture debt, you're going to do it in 6 weeks. Pick us. That is the sale that is given to the company. And you, as the investor, could, in theory, expect about a 10% yield as long as the company is alive for another 3 years. The yield may go to 15 or 20% if the company hits a home run while coming out of debt and you get to cash in your warrants. And the only thing is, some of these smaller companies may have a high entry ticket. They may say we need hundreds of thousands of dollars as a minimum investment before you can play ball. And if you go to the established players, some of those investments, just by the nature of the beast, are going to fail. And they would argue, if you look at the last 5 years, the failure rate is less than 1/4 of 1%, and we are specialists and we're going to do better than the market. But at the end of the day, X% of the companies that borrow will be unable to pay. And even if you're first in line in a place that is in ruins, may not give you your whole buck. So there is always that risk in any investment. Therefore, where do you go next? Get your pen and paper, start thinking. Do you believe that companies that raised money in the previous round, a couple of years before, right after COVID up until now, raised it at very steep valuations. You do the math, the answer may be obvious. And do you believe that there is a cash crunch, meaning some of them have not hit their targets and they are burning cash? And is there an economic downturn coming? That means these same companies will say, I need debt in order to make it. And if the formula is prime plus X% for yield, as interest rates increase or stay high, does it mean venture debt will have a pretty good run in the market for the subset of the companies that will succeed, live for the next 2 to 3 years, have the cash flow to pay off the debt, and some of them may hit the home run? You do the math. So the other part you have to think about is, gee, I'm first in line as a creditor. Do I like that? And I do have this VC who has invested in the company. The VC wants the company to succeed. I suppose they're doing the hard work. I'm just being the rescue line that comes in and gives the company runway. If you came to the conclusion, oh my goodness, this is the greatest thing since sliced bread, let me just give you 3 choices for you to narrow it down. Would you like a 50% chance of making a 10% yield? The only reason I put it at 50%, these are qualified operators. They do a lot of due diligence. They are going to sit here and tell you it's not 50%, it's 80%, it's 90%. You do the math, it's some percentage success rate of getting a 10% yield, especially if you go to unprofitable companies, it is harder. If you only had venture debt in profitable companies, and they were in select industries, of course, that number would go north of 50%. And the second question is, there is also a subset of them that are going to hit a home run. What percent of them are going to hit a home run? I couldn't tell you. We'll pretend it's 15%. You can decide how many companies come out of a downturn in an economy, and you have to do the math and think through what it is. So maybe you will say the 50% is bigger than 50%, really. The 15% is too high, it might be lower, but you got some kind of that kind of an admixture. And then the third choice is, hey, what if I can tell you with near certainty you can make a 5% yield? And those are the 3 choices. Think, you make the choice, and is it A and B, or C? And I'm going to give you a couple of seconds. And if you made your choice, well, let me tell you what that means. If you picked A or B, you're the kind of person who is willing to take on venture debt. If you picked C, you are a bond investor, especially in treasury bonds, because that pays 5%. Now, why do I say 99.99? Remember what is coming. Debt ceiling deadlines within 100 days or so. There may be big yield events in June, July, somewhere around there. Risk may not be your friend. And if it were me, I would skip the higher risk and keep the lower risk. What I mean by that is buy short-term treasuries, sit and wait in cash for the middle of the year and not increase duration. But hey, you make your own decision. Venture debt may just be the right ticket for you. Here is my email address. I'm happy to respond in private. Thank you and have a good day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.